Okay, good evening, good morning to everyone that's joining us from the different parts around the world, and a warm welcome to HANA Shop Simulation webinar. I'm Jacobin Vosloo, Director of Simulation and Technologies at Goldratt Research Labs. And with me today, I've got our two presenters, Dr. DrAlanBarnard, CEO of Goldratt Research Labs, and Dr. Benjamin Schumann, one of our top simulation experts at Goldratt Research Labs. Okay, while everybody is settling in and getting connected, I see we are still having some attendees signing in. I'm just going to put up a quick poll for everybody to indicate whether you've actually used simulation before, and then some guidelines for using GoToWebinar if this is your first time using the tool. So automatically all attendees are muted. If you've got any connectivity issues, you can raise your hand using the applicable buttons in the mobile or web app, and I'll send you a private message and we'll try and resolve it. Also, if you've got any questions during the webinar, you can use the Ask Question functionality provided inside of the app. And we'll endeavor to answer all questions either during or after the webinar in an FAQ email afterwards. So please ask all your questions, even though we might not be able to answer all of them. At the end of the webinar, we'll provide you with a link to the HANA Shop simulation where you can run it online for yourselves. Just a quick overview of the agenda before we start, and I hand over to Alan and Ben. This webinar is scheduled to run for 1 hour. Alan will start with a brief overview of Goldratt Research Labs and the theory of constraints, and then discuss the purpose of this webinar and the simulation. Ben will then do a detailed walkthrough of the app, after which we'll do a summary of the results and try and answer as many questions as possible. So I think that's about, we're currently standing at 43 attendees, so that's a really good number for a webinar. Thank you all for attending, and I'll now hand over to Alan.
Thank you very much for the kind introduction, Jacobin. I'm really excited to bring this to you. It's our launching of our first business simulation game that we've created, and it really ties in very closely to what the vision is of our company, Goldratt Research Labs. We focus on helping organizations and individuals make better, faster decisions, and it's really about helping them answer two specific decisions, which is how much better can you do, just a little bit or maybe a lot, and how best to do it. What's the simplest, fastest way, the lowest cost and lowest risk way of doing substantially better within your organization? How do we go about doing that? We study why good people make and often repeat bad decisions, especially in what is called VUCA environments. So environments that are governed by high volatility, uncertainty, complexity, constraints, and ambiguity. And why do we do this? Why is this our mission? Because we know that the success and failure of organizations and individuals is really determined by the quality and the speed of their decision making. So if we can make a contribution by developing decision support methods and apps to help them make better, faster decisions when it really matters, that's a way of realizing our goal. Over the last 10 years of our existence, we were founded in 2008 on request of Dr. Eli Goldratt to become a spearhead in the development of new knowledge as well as new applications within the area of theory of constraints and wider within the area of decision making within organizations. We've had the privilege of having joint research partnerships with a number of for-profit and not-for-profit organizations. And we use this mechanism as a way of constantly looking at improving the knowledge, developing new applications, new knowledge in order to help organizations and individuals make better, faster decisions. I want to just give a very brief overview for those that are not familiar with theory of constraints, which is one of the backbones of the methodology that we use. There's a great quote by Dr. Kurt Lewin. He was one of the first pioneers in social psychology. He said that there's nothing so practical as a good theory. And it's often a criticism of theory of constraints of why was it called a theory? Well, in science, which is the background of Dr. Eli Goldratt, a theory is simply a good explanation about why something is important and useful. So for example, why is a constraint or knowledge of a constraint in a system really important and useful? Well, it's important and useful for 5 key decisions that managers at any level of an organization has to make. The first one is, how do we set ambitious but achievable goals? Well, if I knew what the constraint of the system was and I knew the potential of the constraint, that helps me to set both an ambitious but an achievable goal. For example, in the supply chain that we will be looking at today, which is a consumer goods supply chain from the suppliers all the way to the retailer, the constraint of that whole system is the number of consumers coming into the shop wanting to buy your product. So if you had to set a financial goal or an operational goal, knowing how many of those customers walking into your shop is actually buying your product and not leaving disappointed is a way of quantifying what the theoretical operational and financial performance limits could be. And that would help us to set both an ambitious and achievable goal. The second decision that knowledge of a constraint helps us is where to focus improvements or investments. So in the case where the constraint is the number of consumers wanting to buy your product, clearly that is where managers at all levels should be focused on, is making sure that we maximize our ability to get existing customers, first of all, to on average pay more or buy more. And by paying more, I don't mean just bumping up the prices. I mean not having to give away unnecessary discounts, for example. And of course, then the second focus area would be on getting new customers that are not currently buying our products or would be interested in our products, getting the awareness for those customers and getting them to buy our products. So the second decision of where knowledge of a constraint really helps us is where to focus our improvement and investments. The next one is, how do we judge the system impact of local changes? It turns out that if we could quantify the approximate impact that a change will have on the system constraint, it's a very good approximation of what the impact will be on the whole system. So if I make a change in the system, all I need to do is to say, for example, if the constraint is the number of customers wanting to buy our product, will this local change impact the average selling price which these customers will pay? Or will it impact the quantity that they would buy? And from that and understanding the marginal cost and investment impact, I can quite accurately quantify the impact of a local change on the system as a whole. But I need to know where the constraint is of the system. The fourth decision that's really useful, that we'll pay quite a bit of attention to in today's webinar, is what's the best rules to use to achieve global and not just local optimization? This is a hard question to answer because often the rules that we need for global optimization is quite counterintuitive from a local perspective or from a short-term perspective. And of course, then the last part is when to change the rules. How do we know when to change the rules? When a constraint moves in the system, we should be changing the rules. So a kind of a key insight is, if I want to be able to run my organization with essentially the same operating method, like the McDonald's way or the Toyota way, a way of achieving that is to make sure that the constraint never moves. And that links us back into this conclusion that for consumer goods supply chain, what is the one resource that if we had more of it, it would benefit every single link in the supply chain? Dr. Goldratt coined the phrase that unless the end consumer has bought, nobody in the supply chain has really sold. So the key constraint in the consumer goods supply chain is the number of customers wanting to buy the end product at a fair price. Well, that's the constraint for the whole system, but individually in each company, there's another type of constraint, which is our limited management attention. And if we are using the wrong rules for making decisions, it can cause us to waste our management attention. It can cause us to do things that we really shouldn't be doing. And it can also cause us not to do the things that we should be doing. And that's really what today's webinar is about, is to show you what the powerful contribution is that simulation models can help us decide what are the best rules to use when we are trying to maximize the performance, not just of one part of the system, but of the whole system. So I will ask Ben to start taking over the sharing of the screen, and he can start opening up the simulation. And as he's doing that, I will provide just a very brief overview of what Ben will take us through in today's simulation.
One second, I'm working. Okay, that's the one. You should be seeing it now.
So as many of you know, Dr. Eli Goldratt, one of the last books that he wrote was called Isn't It Obvious? And it was kind of the goal version for anybody in a consumer goods supply chain that was managing either a distribution company or a retail company. And one of the key parts of the storyline was Hannah's shop, and the challenge that the main character faced of how to turn around a shop that in the past were not doing really well and has been given quite ambitious targets to achieve for the next year. So what we will use the simulation for is, first of all, to see what are the key decisions a store manager would face. And there's really two decisions that we will be modeling here. The first one is the store has only limited shelf space and cash. So one of the first decisions is, of all the products that this suppliers can provide the shop, which few products will this store carry for the next year? And once we've made that decision on which products to carry, we kind of stuck with it for the whole year. So we better have a good decision rule. And the decision rule would be maybe to select those products within each category with the highest sales velocity or the highest contribution margin or the highest profitability or ROI. That's the first decision that we're going to be using the simulation model for, is to decide which products the shop should be carrying. And then the second decision would be, now that we know what products to carry, how are we going to manage the inventory of these products? And there's going to be three subcomponents to that decision, which is the planning rules, which is how do we decide initially at least how much of each product in each category should we be carrying in our store? We call that the target stock levels. Once we've made that decision, the second sub-decision would be when and how much should we order for each product to ensure we have the minimum level of shortages and surpluses. And then the last decision, which is our continuous improvement decision, would be when do we change our decision in terms of the target stock levels? When should we increase the target stock levels? Maybe because the forecasted sales was less than what the actual sales were, and now we're constantly running out. Or maybe we need to reduce it because the forecasted sales was higher than the actual, and if so, by how much? So Ben is going to take us through a demonstration to show you what a simulation tool like Hannah's shop can help managers facing the tough decisions about, for example, what products to carry and what's the best rules to manage, and how we could use the simulation to quite accurately predict the impact of choosing one product over another or choosing one rule over another. So I'll hand over to Ben now.
Thank you very much, Alan. Warm welcome from my side as well. I'm very excited to show this today. So as you can see, you are welcomed to this model. You are welcome to our little toy world, and you are now the new manager of this branch of Hannah's shop. Now, what you will see throughout this model is always help functionality. So we try to be very supportive in trying to learn more, or just having a question, you know, what is this screen, what's going on, what are all these terms? So feel free to use those. And also just be explorative. You can click on everything and things should not break. It should be quite stable. So let's get started, like this button is inviting us. And the first thing that you will see is that you receive an email that you have been appointed by the regional director to become the new store manager. And no need to read through this now. This is basically what Alan was just describing. With this promotion for you, what happens is that there are two things that you need to decide to manage your store for the next year. The first is the product selection, and the second is which inventory rule do you actually want to follow. Now, to make that decision in the real world, what you typically do is you look at your past performance, what happened last year, and you make up a sales target. And luckily, your colleagues have already done that for you, and they've prepared a sales target based on historic performance. And what they've come up for you is that they really would like you to hit a ROI of about 39%. Now, how does that come about? It's fairly simple, although it might look a little overwhelming. So we have 4 different product categories that you have to sell. We have fast mover products that sell fast but don't cost a lot. We have daily dollars, weekly winners, and monthly margins, just selling less and less often, but actually costing more and more and giving you a higher profit margin. So for example, for fast movers, our colleagues expect to sell about 7,000 over the course of a year at the price of $5, giving you an expected revenue of $35,000. They cost $4 to buy, so your variable cost is $28,000, leaving you with a gross profit of $7,000. And adding all that up, you end up at about $30,000 of gross profit. We have a fixed operational expenditure that we deduct. We arrive at a net profit of about $2,200. And the ROI is then the ratio of what you gain at the end of the year over what you typically invest per month. So it's the return on investment on your investment. So keep that number in mind. We will see it again. This is what we would like to achieve. We at least want to beat our previous, the previous manager. So having reviewed this, the very first decision comes up. You need to start choosing your products for the next year. So let's have a look. This is your product selection page, and the company policy is very strict on how many products to choose. In total, you have to fill these 10 slots, and you have to fill 4 slots for monthly margin products because they have a high margin. And you have to fill just 1 slot for the fast mover product. So you can only choose 1 fast mover product and 4 distinct monthly margin products. If you click on one of those slots, you can go through the different fast mover products and you can see their specific characteristics. So for example, this is a low risk product and we expect it to sell a mean of about 7,000 a year, but it has a very small fluctuation or volatility. So if you click on it, you'll also get a help message. Low risk products have reduced mean sales, but also less volatility. And then high risk products, they will sell more on average, but they'll also have a massively higher volatility. So it's your call how you want to select and create your product profile. And you can see as soon as you start selecting products and filling slots, you will have an updated expected sales and expected gross profit calculation, and also an indicator of how risky is your product portfolio. Now, what we're going to do is you have 3 options or 4 options essentially. You can make up your own portfolio. You can also just say, please just give me low risk products and it will populate everything with low risk products. Or please just give me high risk products. or you can just say, please fill everything with random products. So we'll have a couple of low-risk products, medium-risk products, high-risk products, and on average, you can see our risk level is around about medium. So given that we know that our predecessor was working with these kind of products as well, medium risk, not too high, but also not too low, we'll go with that as well. And we'll make the decision now to have a mixed product portfolio. So once you're happy with your product selection, then the second big decision is coming up, and that is, how do you actually want to run the next year? So we'll start choosing our inventory rule. And this is where things get interesting now. So this is sort of an overview table of all the things that you can play with in this model. So we have 3 different policies that are called min-max, economic order quantity, that's EOQ, and the theory of constraint approach, or TOC. So you'll be able to play with those 3 policies, and you'll be able to test how would they behave in a perfect world where we don't have any random fluctuations versus how would they actually play out in the real world with variability, where demand varies a little bit, supply lead times vary as well. And you can compare that to your actual sales target. So in the spirit of trying to figure out how good was actually our previous manager, was he somebody that was just following rules, or was he somebody that was sort of working based on his experience? You know, he's worked at the plant for many years. How good was his performance actually? What we can now do is we can actually test that, and we can say, what would have happened if he was using the min-max rules initially just for the perfect world? And if you wonder what min-max actually is and how it works, you can always click on the question mark and it will explain to you exactly how it works. Essentially, you let your products or your inventory run down to a minimum number of products upon which you order new products, and at some point you basically order up to a given maximum level. At some point they are delivered, and then your stock reduces again. So it's as simple as clicking the play button and seeing what actually happens. So as soon as I click the play button, it now takes us into actually Hannah's shop, into the warehouse. We can see the inventory in 3D. We can see the products that we've selected, and we can see how the days are passing. And we run for 1 year, which is made up of 240 days in this model. And what you can see immediately is that the fast mover is selling quite fast, whereas the monthly margins are selling slow. If you zoom out a little bit, you can pan and drag. You can see when things are delivered. You can see from time to time their deliveries. We also send orders out from time to time. And if you want to be really impressive, you can even show the customers and how they arrive at the shop and sort of wait for their product, and after some time they get it and then leave the shop again. And if they actually don't get it, they will even start to queue. They won't get angry though. So this is one way of analyzing the model, but also there are these tabs. So we're really just looking at this perfect world min-max policy scenario now, and we can look at 3 different ways of analyzing that. We can look at the individual inventories. So this is a more detailed view of how the products developed over time. We recognize our 10 products again, and we can see how they followed the min-max rules. For example, product 17 here is a daily dollar. So we sell about 3 units per day on average, and it's low risk. And we can click on this little zoom button to enlarge the inventory chart for this product. And let's have a look what's going on here. So on the horizontal, we see the number of days per year, and we model 1 entire year. On the vertical, you see the number of units that were in stock for this product. So we started off with a fairly high value, and then over time, we typically sold about 3 of those per day. If you hover over the chart, you can see the different data items. So this red item down here, these dots are the actual daily demand. And it's really flat because it is a perfect world scenario. Only from time to time, because of rounding, is there a little less demand on specific days. So at some point, we go below the minimum value and we actually order more stock. So our stock on hand is this dark blue line, but there's also the total stock, which is stock on hand, SOH, plus the stock on order, which is the stuff that we ordered. And the lead time for this product is quite short, it's just a day. Now, it is interesting to now see, well, does this actually make sense? So this product typically sells for 3 units, or we sell 3 of them per day. Now, if you think about it, it has a supply lead time that's typically 1 day. It can be up to 3 days in this case. So actually, you never really would need more than 9 products in your store, would you? Even if the supply chain, if it's the worst case, you still have 3 days worth of products in your stock. Now, if you look at this min-max policy, you can see on average, it stores about 30 units. So at least 3 times more than what you would intuitively expect to see. And we can go back to this overview and look a little closer on what else is happening. We can compare the sales revenue by product category, like how many variable costs versus gross profit did you have, and you can compare it to the sales target that you were left with. We can compare the ROI. And here it gets interesting, right? Remember the 39%, that's what you're supposed to hit. Now, if you would have run the min-max policy in a perfect world, you really would only have been able to reach 17% of ROI. And if you're interested, there is a filter button here where you can take this even further and actually filter by individual products and update those numbers to see how is each individual product contributing to the ROI. And once you're happy with analyzing this individual one for the perfect world min-max, you just click on back and you're back at this overview page, or this one. This is the one that we've seen previously, and now you can see the results from your one. So you wonder, well, did my predecessor actually follow this rule then, or did he do something else? And you can check, well, how would this rule actually perform in the real world? So let's run this one and see what's happening there. The model typically runs quite quickly automatically, and we just can let it run. We can see how the inventory charts are developing. And once we're happy with this one, we can actually look a little closer here. If we look into the same product now, product 17, you can see there is now a little bit of variation on the demand, but it's not very much because it is a low risk product. So there's not a massive amount of deviation on the demand. But if you look at product 5, for example, this is a high risk product. Here things already look a little more variable. So what's the total ROI for this one then? It is actually a little even less. And that makes sense because we now have a real world scenario. We have random fluctuations, and the min-max rules are really quite rigid and are not designed to work with fluctuations, with changes in the environment. So it's very easy to lose money in the real world with min-max. Well then, maybe our predecessor actually followed the EOQ rule then. Let's have a look at this one. And economic order quantity is structurally different to min-max. So in the economic order quantity world, what you do is, we can actually look at the inventory. You basically wait until your inventory drops under a specific lower limit. For example, round about here, for this one, it's about 7 products. And then you order an economic order quantity that is based on a specific mathematical formula that basically optimizes or trades off how much should you order given the cost of ordering. So this one is a little more flexible, and you can see the products behave fairly differently to min-max. Things are ordered much more frequently. So let's see what the overall result of this one is then. And interestingly, the ROI is a lot higher than with min-max. And we are now getting into the range of where our predecessor was. So maybe he was using those rules. But let's check how the EOQ then performs in the real world. And again, you can watch it in 3D. Let me speed up a little bit. And finally, it adds up with an ROI that again is lower than its perfect world equivalent. And again, that is because the EOQ rules cannot cope with stochastic fluctuations. Let's have a look at what EOQ actually is. So as I said, it's called a reorder point when you follow economic order quantity policies. So the reorder point, you can see here how it's defined for the different product categories. And you can also see what the economic order quantity is for the different categories. So how is it actually, how is it actually deciding those values? That is based on specific formulas, which are described here as well. So what can we do? We still haven't hit what our predecessor has done. So maybe we should actually start thinking about a new way of managing our inventory. And theory of constraints is one of those new ways. Essentially, what it is doing is that it sets a target stock level that is dynamically changed all the time depending on how you actually sell, how the system actually performs. So say if the demand suddenly rises because it's Easter or Christmas or something, following the TOC rules, your target stock level will also automatically rise. And you will automatically ask your suppliers, please send me more stuff of that. And at the same time, if demand falls, your TSL will also fall. And what we'll see is that it will follow the demand. And first, again, we run the perfect world scenario. And what's already interesting to notice in the 3D window is that you have a lot more orders coming towards your warehouse. Because in TOC, you typically order much more frequently than in min-max, and also more frequently than in EOQ policies. And in this model, we actually order daily. So every day we look, how many products do I need to actually get up to my target stock level again? And at the same time, continuously monitoring how is the demand or my sales actually progressing, and how should I amend my target stock level. So let's wait until this guy is done. I'm doing this on my laptop. This is probably a little bit slower now because it's recording at the same time and my laptop is struggling. Normally it runs quite smoothly. And what you'll see is the link that we're sending you after this webinar will take you to a cloud version where you can actually basically run this in the cloud. So it's not even running on your machine. You'll be able to interact with it, but the actual calculations are done in the cloud. So you basically just see the front end and the animations. You can interact with it just like I'm doing here, but you're basically independent of your local machine power. You could even run it on your iPad if you wanted to.
Ben, I think an important thing to stress here as the simulation is finishing up is that there's obviously could be a concern that if you place smaller orders more frequently on your suppliers, will it not increase their cost or your cost, or maybe both? And that's one of the benefits of using simulation models, is that we can accurately model what costs are truly variable, what costs are stepped variable, and what costs are fixed, so that we can see what the total cost impact will be of a change. We recently built a simulation model, very complex simulation model for large book publishing supply chain. And what that showed was it showed that even though the local cost, maybe if you're printing smaller quantities, the per unit cost might go up because you're running smaller runs, the actual total cost reduced quite substantially for the whole system. So that's one of the ways that we could use simulation models, is not just look at what the local impact of a change would be, for example, on cost, but what the system-wide impact would be. And that often could be counterintuitive, like ordering smaller quantities more frequently. We expect that costs might go up, both in terms of ordering cost and distribution cost, but the total cost actually significantly comes down quite often.
Thanks for that, Alan. So in the meantime, the simulation has finished and we can now observe our TOC perfect world scenario. And you can see it looks, even characteristically, it looks quite different. Let's again look at our product 17 as a starter, which is a low risk product. And you can see it looks peculiar compared to the previous policies. So what's happening is that we have a target stock level that sits here at the top of the chart at 12, and the demand is very, very constant, as I've shown you previously. And that means that the TOC policy reorders stock to have a very constant stock level as well. Nothing is varying, nothing is changing. And the total stock is also much, much lower, but we'll see that in a second. But let's look at one of the more variable products, like product 5, which is a high-risk product. And that means it also has seasonal variation. So you can see over the course of the year, although the demand per month is still constant because it's a perfect world, we have seasonal fluctuation of the demand. And you can see how the target stock level, that green line, is updated, reflecting the different changes in the demand. And it's sort of, at some point, it's not going down anymore because the rules dictate actually that it is sitting in a sweet spot, which is typically just below the yellow threshold, as we call it. Now, the more interesting thing is to run the real world TOC. And I hope this one will be quicker. Because now we have random fluctuation and we have random or fluctuating supply lead times. We have the seasonality for high risk products. So there's a lot of stuff going on that the TOC rules now have to follow. And what you'll see in the inventory charts is that it's finished now. That's great. That the target stock level is following the random demand much more closely than the min-max rules or the TOC, the EOQ rules could do. So let's look at this guy again, the high-risk product 5, and you can see, you can see how the target stock level is quite closely following what's actually happening in your stock levels. If the stock is going up, your target stock level goes up, then you can see the stock is not actually massively going down. So the target stock level is not reducing, but it would if the demand would be changing accordingly. So remember that sort of intuitive test of the min-max rule where I said it seems to be holding about 3 times more than you'd actually need for such a product. We can actually compare across the different policies and perfect world versus real world by actually saying, please show me the inventory chart just for product 17. That's the one that we always be interested. And now we can also actually say, please show it with the same scale. So you can now see these are all to scale, and the stock level that TOC typically holds for this product is a lot lower than EOQ, which itself is a lot lower than the min-max. And you can compare that for all the different products. And for some products like this one, you also see stockouts, these vertical gray lines, which happen when the demand is suddenly so high that the inventory can't actually cope. You also have the ability to compare financial metrics, for example, lost sales. So in the real world, in the perfect world, we sometimes have lost sales due to seasonality, because there's sometimes a surge. But typically lost sales occur much more in the real world, where we have these random fluctuations and the inventories can't actually cope. Now, the last thing I want to share is, again, the help functionality. So whenever you see a little question mark, click on it. There is also the ability to sort of analyze and answer questions. So what is the difference between perfect world and real world? Again, you can just click on it and it will explain that in more detail. The question of what's the difference between the sales target in the perfect world? What were the differences between these three policies again? And we try to be quite clear and intuitive in trying to explain different things. How is the planning actually working? How is it actually executed? And how are the rules adjusting themselves over time? What are the parameters that we've been using in the model? And one last thing, or two last things actually. Now that we've just run this with one set of products, there might be two things that you're interested in. One is, well, maybe I should have chosen different products. Maybe my predecessors actually chose different products. I'm not actually sure. And in that case, you can always open this menu and actually create a new product setup. So you just click on this drop-down list and say, please create a new product setup, and it will take you to this familiar page where you can now say, actually, what would have happened if I only chose low-risk products or high-risk products or any of the products that you want. And then second, this will not be available in the demo version that we upload, but later in the full version, there are also advanced settings where you can play around with actually not allowing randomness, using different currencies. You can play around with pricing settings, you know, and actually adjust this to reflect more the reality or maybe of your own plant or of your own clients. You can play with cost per orders and actual demand adjustments. So it's all there, and we try to make it as open and flexible as possible. That's all I wanted to show from my side. So in the agenda, what we were planning to do next is to give you a brief summary and next steps. So I would hand over to Alan for this one, and then we can take a few questions as well.
Thank you, Ben. So maybe while I'm talking, if you could just run in fast mode the simulation again and show the results of all the rules in combination. I think there's a few questions, really good questions that have been asked that I could answer with that in. There was a question regarding the total cost, and that's something that we've paid a tremendous amount of attention to. If you think about it, there is, of course, the obvious cost, which is the purchase price that you pay when you are buying a specific product from a supplier. So that is accurately modeled in the simulation. It's a fully variable cost. If there were real variable costs in terms of placing orders, doing picking, doing transportation, those could either be modeled as variable cost or as stepped fixed cost or fixed cost if the equipment or assets belong to you. So all of those costs can be modeled very precisely to allow us to see not just the local impact of a change, but the global impact of a change. As I mentioned, whether choosing one rule over another, will it increase the total cost to the system? And in our very advanced full supply chain models that we build for clients, we can actually see what the impact will be on your financial performance versus your supplier's financial performance versus your customer's financial performance. So that's something that we can do very precisely inside of the model, is to model very precisely all the costs that will be incurred to be able to see whether the total cost will go up or down. There was also a question regarding DDMRP. For those that are not aware, this is a new rule that had been created a few years ago by Demand Driven Institute. It's called the Demand Driven MRP, and it's a rule that definitely is addressing many of the shortcomings that we see within min-max and EOQ. So it's a rule that is also looking at what is really happening on the demand side, but it also has a mechanism of looking forward into the future of being able to say, when should I pay attention to forecast? Should I be recalculating my target stock levels? Based on that, what's the estimated level of variability in the demand and supply chain? So it's asking the supply chain planners to provide their subjective inputs around that. And that will definitely be one of the future enhancements in this model, as well as all the other supply chain models, is that we will be including new rules like DDMRP and other rules, essentially whatever you can come up with. If you think about that there might be a better way of doing it, we can test those hypotheses. Inside of our own research labs, we've developed a number of hybrid theory of constraints rules that is achieving really, really spectacular results in real life environments. These are rules that we've implemented, for example, at Microsoft to manage a very large percentage of their device supply chains, and we are also implementing it in a number of different industries. What makes the simulation very special, as you could see, is you can precisely define that rule, run the model with 100% compliance, which is sometimes very difficult in real life to achieve, to know that people are really following the rules all the time, unless we've automated it in our ERP system. And we can see how that rule will perform in a perfect world environment as well as in a real world environment. And an important thing to always remember is that principles are generic, but rules are specific. Rules are designed for specific boundary conditions. So one rule that might work really well in an environment where there are long supply lead times and relatively infrequent ordering could end up being quite a bit of a disaster in an environment where there's short lead times or very short frequency of ordering, or in environments where the fluctuations is really large, or where there's spikes in forecast is substantially different from what we expected to happen. So the simulation models is really just a way of testing what the impact will be of switching from one rule to another. Another very interesting aspect that we could use the simulation for is, some of you might have seen my lecture on anti-fragile. This is the idea that we want to have rules to manage our system that has a small downside if our expected sales is less than, our actual sales is less than what we expected. So in cases of a market downturn, we wanted to have limited downside. And at the same time, in cases where we've had a great day or a great week or a great month, that we want to be able to fully capitalize on that. So when we have rules in place that have limited downside when things don't work well, but they have almost unlimited upside when things work well, we can get systems that become anti-fragile, that actually benefit from volatility. And it's very, very interesting to us as a team. You can imagine we've run a few simulations in our lifetime, but we were still surprised when Benjamin was showing us some of the initial results, where in some cases, as you could see, as you add variability, the results go down. But we found quite often cases where, especially in a TOC case, where as you increase volatility, so variability in demand and in supply lead time, the real world environment actually outperforms the perfect world environment, which gives us a hint that these theory of constraints rules love to be able to deal with volatility, and it can end up performing even better in real world scenario than what we would have predicted in perfect world environments. So that's just a brief summary. I think, Ben, if you could just show quickly the return on investment screen again. So just to do a direct comparison of all the rules, and click on the KPI side there. So in summary, what we were able to show here is, if you were doing static calculations where you'd assume average demands and average supply lead times, then you would have been able to probably get results that reflected quite closely what we showed there in perfect world environment. As soon as we've added the variability and interdependencies that we see in real world, we can see that the real world scenario could be a little bit different or could be a lot different. If you have for many years been using one specific rule like min-max or even EOQ, you might have convinced yourself that that's the best that your system can do. Whereas the simulation have shown us just by changing a rule, something that's actually a pretty small change that can be implemented almost overnight within any modern ERP system, you can dramatically increase the financial performance. You could simultaneously reduce shortages in order to increase sales and therefore net profit, while at the same time, you can dramatically reduce surpluses. If you compare, for example, the inventory levels of around $4,800 on average with what TOC was able to achieve of only $1,000 in the perfect world environment and only slightly more in a real world environment. So that's the idea of these simulation models. The HANA Shop is one of many that we have developed at Goldratt Research Labs. It's specifically focused for consumer goods environments where you either own the distribution center and or the retailers, and it helps you to check what the impact would be of changing the rules within your environment. As Benjamin indicated, there's a number of ways that you could potentially use the simulation model. One is just to better understand what the real dynamics or the performance would be of the various rules and to gain insights into why it would be different. Another way would be that you could use this model, of course, for training. So if you are responsible internally for managing the supply chain and coming up with best practices, you can use this model using the settings that Benjamin showed to kind of customize the settings to more accurately reflect the type of products that your company is selling. You can modify the demand, you can modify the selling prices, the purchase prices, you can modify all the various transportation costs, supply lead times. All of those parameters are relatively easy to adjust so that it can be customized for your environment, and we can even co-brand it for your specific company, for example. Of course, if you are in consulting and you would like to use this model as part of your pre-sales tool to be able to convince customers that there would be a substantial benefit in maybe implementing TOC rules or maybe DDMRP rules, you could also use the model for that purposes. And of course, from an academic perspective, it is a great tool to be able to teach students that has not had real world experience to see how the various rules will perform in real world environments. So there's a number of different ways that you could use it. As we mentioned also at the beginning, we are planning to release this simulation game to the public. There will be a number of ways that you could use it. Initially, we're going to be launching it as a free cloud-based version to get as much feedback as we can from each of you. So you have a real chance here of influencing the development pipeline of what we would be including in the development until the end of January when we are planning to launch this tool. But there will also be an additional option after we go live that for probably around $100 a year, you can subscribe as a single user license to be able to use the model. We will also offering a customized version where you can, for example, bring in pictures of the type of products that you sell to customize it more for your environment, and then we would have a full customized version with co-branding, etc. And over the next month or two, we'll release the pricing for that. So that's all from my side. I really hope that you found this webinar informative and that it's given you a good hint about the power of the simulation tool. For those that would like to have access to the model, and we would really appreciate your feedback directly from using the model. Benjamin was showing the link there. It's really just hanasim.goldrattresearchlab.com. You can just click on that URL or type the URL. That will take you straight into the cloud-based version of the model. There will be a big play button there. You click on the play button, and that's how you can start the model. You can run it in any browser, even on your smartphone. It's a little bit small for the smartphone, so I would highly recommend to do it on a desktop or to do it on your notebook or even a large tablet. And it hopefully the instructions are pretty counterintuitive. You just read through the instructions, you click on got it. It does have a time limit, this cloud-based version, of around 4 minutes, but of course, if you've exceeded the time limit, it will just show that your session has expired. You can click on the close button and just start a new session to maybe test some additional functionality. So thank you very much again for attending, and we really look forward to getting your feedback both on the webinar itself. This is the first of many that we are planning for 2019, as well as getting your feedback on the simulation. So I'll hand over back to Jaco just to close it off.
Okay, thank you, Alan and Ben. That was really insightful, and I see we've got a lot of great comments about it. If anybody has got any specific questions about HANA Shop or any of the other simulation tools Alan has talked about, you're welcome to send us an email at info@goldrattresearchlabs.com or visit the website for more information. Thank you all very much for attending. It was really a great event to host, as well as get all the great feedback. Thank you so much.
Thank you.
And just a last comment from my side, we mentioned that for all of you that have attended, we have recorded the session, so you'll be able to watch it again. If you maybe want to watch it with your team, you are welcome to do that. And for all those that have attended, you of course are welcome to access the simulation model in the cloud-based version, and we look forward to getting your feedback.
Okay, I'll keep the webinar open for a couple of minutes longer if anybody wants to post some more questions. Thank you so much.